The SP 500 is supposed to be the absolute bedrock of American wealth. It is the default setting. The financial gospel we are all taught to blindly trust from the moment we open our first retirement account. Just buy the index, hold it forever, and eventually walk off into a comfortable sunset. And if you glance at your portfolio balance today, you probably think the system is working flawlessly. The market is hitting dizzying historic highs. Sounds pretty good. Now open up that index fund and actually look at the underlying mechanics of what you own. You are no longer holding a heavily diversified, resilient basket of American industry. You are holding a hyper-concentrated tech fund. Right now, just 7 massive technology companies make up nearly 30% of the entire index's weight. That is a massive statistical anomaly. We have not seen this level of extreme, top-heavy market concentration driving valuations to these euphoric highs since the absolute peak of the dot-com bubble in the year 2000. You can look at the historical data yourself. The broader market is not actually thriving. A tiny handful of megacorporations are simply dragging the other 493 companies up a very steep, very fragile cliff. Because of this extreme concentration, and the terrifying volatility risk lurking quietly right beneath the surface, I did the unthinkable this morning. I logged into my brokerage account. I took a deep breath. I hit sell. And I completely liquidated my entire SP 500 index portfolio. Every single share. That sounds like absolute financial heresy. It violates every rule of mainstream personal finance. But if you are in your 50 seconds or 60 seconds right now, meaning you are either staring down the barrel of retirement or you just entered it, this urgent update is specifically for you. When you are 35 years old, a massive market crash is just a blip on the radar. It is a buying opportunity. You have decades for the mathematical averages to smooth themselves out. But when you are 58 or 64, a 40% portfolio drop is not a blip. It is a catastrophic, life-altering event. It is the difference between enjoying your hard-earned freedom and being forced right back into a cubicle to pay your property taxes. You simply no longer have the luxury of time. You do not have the runway to recover from a massive market correction. The passive, set it and forget it strategy heavily assumes you have an infinite runway. You do not. This brings us to the actual mechanics of what I am doing with my money instead. I am shifting my entire financial architecture to what I call the yield-first preservation protocol. For the last 30 years, you have been playing offense. You were in the wealth accumulation phase, relying on a growth-dependent model where the only thing that mattered was the share price going up. But the rules of the game fundamentally change the moment you transition from building a mountain of money to actually living off it. We are pivoting to a cash flow and defense model. It is no longer about maximizing your theoretical peak net worth. It is about building an unbreakable fortress around the wealth you already have. Here is what nobody in the financial media says out loud, because it ruins the simple, uplifting narrative. The common misconception, the idea drilled into our heads, is that buying and holding the SP 500 forever is the ultimate, fail-safe retirement strategy. Just ride out the bumps. They say, the market always goes up over time, but the actual reality is a silent wealth killer called sequence of returns risk. Let me explain exactly what I mean by that. If the stock market drops 40% right as you blow out the candles on your 60th birthday, and you are forced to sell shares just to buy groceries and pay the electric bill, your retirement account is permanently crippled. It does not matter if the market goes on a historic, roaring bull run for the next 30 years. You sold those shares at the absolute bottom. They are gone. They cannot capture the recovery. You are experiencing a mathematical death spiral. draining a shrinking pool of assets just to survive. To stop this from happening, to completely neutralize that risk, I had to replace the S&P 500 entirely. I took that massive pile of liquidated cash and aggressively reallocated my wealth into a strict, three-tier post-S&P portfolio framework. This is not a generalized financial theory. This is a rigid, mechanical system designed specifically to protect investors over the age of 50. It operates in distinct layers, completely separating your immediate living expenses from the unpredictable chaos of the stock market. Think of this rigid framework like a watertight dam. The foundation is Tier 1, consisting entirely of short-term treasuries and cash equivalents. I moved a massive chunk of capital directly into 1 to 3 month treasury bills yielding right around 5%. This mathematically strips away market volatility from your immediate daily life. It guarantees pure, uninterrupted liquidity to cover your next 3 to 5 years of living expenses. If the economy craters tomorrow, your mortgage and your groceries are completely insulated. You are never, ever forced to sell stocks at a devastating loss just to keep the lights on during a long recession. You have essentially bought yourself half a decade of total financial immunity. While Tier 1 is your defensive moat, Tier 2 is the engine. Capital is instead deployed into dividend aristocrats and value ETFs. We are completely abandoning the hope and pray strategy of relying on share prices pointing up. Instead, this money buys ownership in mature companies that have legally raised their dividend payouts for 25 consecutive years or more. These are the boring, sprawling businesses making the toothpaste and infrastructure the world consumes regardless of economic panic. This creates a predictable, relentless stream of passive income. It acts exactly like a synthetic paycheck, replacing the salary you left behind, completely indifferent to whether the stock market is flashing red or green. Finally, we lock the perimeter with Tier 3, comprised entirely of hard assets. I allocated a distinct percentage of the portfolio to things that actually exist in the physical world, like real estate, physical gold, and broad commodities. The entire point of this tier is that it shares zero correlation, or even an inverse correlation, with the broader equities market. If that historically overvalued, tech-heavy S&P 500 suddenly cracks and drags the economy into a lost decade of stagflation, virtual wealth will evaporate rapidly. Tier 3 is your definitive hedge against that nightmare scenario. It protects your actual purchasing power when paper money loses its teeth. It acts as the heavy iron anchor that prevents your entire portfolio from drifting out to sea when macroeconomic winds violently change direction. Part 1. So your ship is secured. The next step requires exactly 5 minutes of your time, and it is the most critical action you can take today. Right after reading this, do not check the news. Do not scroll to another video. Log directly into your 401 or brokerage portal. Find their portfolio analysis tool and calculate your exact percentage exposure to the top 10 tech stocks dominating the S&P 500. You might think you are broadly diversified across 500 companies, but you will likely find a massive, disproportionate chunk of your life savings riding on the daily mood swings of just a handful of Silicon Valley giants. You need to see that number with your own eyes. It is the financial equivalent of discovering the load-bearing walls of your house are made of glass. By running this quick calculation, you will see exactly how vulnerable your target retirement date actually is to a single sector's inevitable crash. This is your window of opportunity. Seeing the reality of your concentration risk allows you to proactively lock in those historic profits and intelligently reallocate your portfolio right now. You do this before the market violently corrects and forces you to sit at a desk, answering emails for 5 extra years just to build back what you lost. We are taking the chips off the table while the casino is still handing out winnings, rather than waiting for the doors to lock. Are you in your 50s or 60s and still holding 100% of your wealth in stocks? Drop your target retirement age and your current SP 500 allocation in the comments below. Share this strategy with a friend approaching the retirement finish line blindfolded. And hit the subscribe button for my weekly portfolio updates. In the end, wealth is not just about what you accumulate when times are easy. True wealth, the kind that lets you sleep peacefully through an economic storm, is entirely about keeping what you have already earned. You traded decades of your limited time on Earth for that money. Do not let a shifting market take it back.